Welcome back. Today we're breaking down 7 of the most buzzed-about stocks across biotech, EVs, and crypto. These are the tickers you've seen everywhere: PROK, NDRA, WKHS, ZEPP, BTCS, CURR, and LGPS. Each comes with big opportunities and even bigger risks. I'll cut through the hype, break down what these companies actually do, and give you my verdict: buy, hold, or sell. Remember, this isn't financial advice, just my take to help you do your own research. Let's dive in. First up, PROK, PROK, a biotech aiming to revolutionize chronic kidney disease treatment. Their lead product, React, uses a patient's own kidney cells to try to restore function, a potential game changer if it works. But here's the catch: they're still in clinical trials, burning cash, and have zero revenue. The stock is extremely volatile, swinging wildly on trial news. Investing here is a pure bet on a single scientific outcome. If React fails, the company's value could collapse overnight. They've diluted shareholders with capital raises and the risk is sky high. The bull case: FDA approval and a biotech moonshot. The bear case: failure in trials and a wipeout. For most investors, this is a sell, or at best a watch from the sidelines. Only consider it if you're comfortable with casino-level risk. I prefer companies with proven products and real revenue. For now, PROK is just too speculative. Verdict: avoid. Next up, let's talk about Endra Life Sciences, ticker symbol NDRA. A small but ambitious medtech company that's trying to shake up the world of liver diagnostics with its TAEUS system. This is a company that's betting big on technology to change how we detect and monitor liver fat, a growing health concern worldwide. Their goal is to make liver fat scans not only cheaper, but also far more accessible than the traditional MRI scans that are currently the gold standard. MRIs are expensive, time-consuming, and not always available in smaller clinics or developing regions. Endra's TAEUS system, which works alongside standard ultrasound machines, could potentially bring advanced liver diagnostics to a much wider population. The technology is promising, especially as it targets the massive and growing market of non-alcoholic fatty liver disease, or NAFLD. This condition affects millions globally and is often underdiagnosed due to the limitations of current scanning options. If Endra's system works as intended, it could help doctors catch liver issues earlier and manage them more effectively. The company has already achieved a significant milestone by securing regulatory clearance for its device. But as anyone in the medical device industry knows, getting the green light from regulators is just the beginning of a much longer journey. The real challenge now lies in convincing doctors, hospitals, and healthcare systems to actually adopt and integrate this new technology into their daily practice. Changing established medical routines is never easy, and it often takes years of persistent effort. Sales cycles in the medical device world are notoriously long, with multiple layers of decision-makers and budget approvals. Breaking into this market is tough, especially for a small company with limited resources. Financially, Endra is burning through cash at a rapid pace. Revenue remains minimal, and the company's cash runway is short, meaning they'll need to raise more money soon just to keep the lights on. That means more dilution for existing shareholders is almost inevitable as they seek additional funding. Each new round of capital raises chips away at the value of current shares. The stock trades as a penny stock for a reason. There's a huge execution risk here. The company's future depends on its ability to turn promise into real-world adoption and sales. Endra must prove it can actually sell the TAEUS system at scale, not just in pilot programs or small trials, but in meaningful numbers that move the needle financially. Until that happens, this remains a highly speculative play. The risks are significant, and the path to profitability is far from guaranteed. For new investors, I'd call it a strong avoid. There are simply too many hurdles and too much uncertainty at this stage. The risk of failure is just too high, and there are safer opportunities elsewhere in the medtech space. If you're already holding shares, keep a close eye on whether Endra can generate real sales traction. Otherwise, it's best to steer clear for now. My verdict: avoid. Let's talk about Workhorse Group, ticker WKHS, a company that's been trying to carve out a niche in the electric vehicle world, specifically with commercial delivery vans. While the EV space is full of big names and bold promises, Workhorse has always positioned itself as a scrappy underdog, hoping to disrupt the last-mile delivery market with its electric solutions. Early on, there was real excitement around Workhorse, especially when they were in the running for the massive USPS contract. But losing that deal was a huge blow, and since then, the company has struggled to regain its footing or deliver on its early potential. The road hasn't gotten any easier. Recalls have forced them to pull vehicles off the road, production delays have slowed their ability to scale, and the company's high cash burn rate has raised serious questions about its long-term viability. New management has stepped in, promising a turnaround and a fresh approach. But let's be honest, the competition is absolutely fierce. Giants like Ford and Rivian are pouring billions into their own electric commercial vehicles, and they have the resources, scale, and dealer networks that Workhorse simply can't match right now. Workhorse does generate some revenue, but the harsh reality is that they're losing money on every vehicle sold. Their cost structure is out of balance, and until they can achieve scale and efficiency, profitability remains a distant goal. To keep the lights on, Workhorse has had to raise capital multiple times, which means issuing more shares and diluting existing shareholders. For investors, that's a tough pill to swallow, especially when there's little sign of a turnaround. The EV market is more crowded than ever, with new players entering all the time and established automakers ramping up their own electric offerings. In this environment, Workhorse is fighting an uphill battle just to stay relevant, let alone thrive. Turnarounds in the auto industry are notoriously difficult, and for a company with Workhorse's track record, the risks are even higher. Investors have seen promise after promise, but real progress has been slow and setbacks frequent. Before I'd even consider investing, I'd need to see consistent production numbers, positive gross margins, and a clear, credible path to profitability. Right now, those things just aren't there. There are simply safer, more promising EV plays out there. Companies with stronger balance sheets, proven products, and real momentum. For me, Workhorse is a clear sell at this point. The risks far outweigh any potential reward. Too many broken promises, too little progress, and too many red flags for comfort. If you're still holding shares, keep a close eye on actual improvements. Don't just listen to the hype. But honestly, I wouldn't bet on a dramatic turnaround. The risks here are just too high, and the odds of a successful comeback are slim. There are better opportunities elsewhere in the EV space. My verdict: sell and look for stronger companies with real momentum and a proven path forward. ZEPP Health, trading under the ticker ZEPP, is the company behind Amazfit smartwatches, a brand that's become synonymous with affordable, feature-packed wearables. Over the past few years, ZEPP Health has carved out a significant niche in the global wearables market, appealing to budget-conscious consumers who want smart features without the premium price tag. The company ships millions of devices every year, reaching customers in over 90 countries. Their global footprint is impressive, and their annual revenue consistently tops $1 billion, a testament to their scale and reach in a highly competitive industry. But despite these big numbers, ZEPP Health's profit margins are razor-thin. The competition is relentless, with giants like Apple, Samsung, and Fitbit dominating the premium and mid-range segments. ZEPP is forced to compete on price, which squeezes profits even further. In recent quarters, the company has reported declining revenue and mounting losses. The wearables market is maturing, and ZEPP is feeling the pressure as growth slows and costs rise. As a Chinese company listed on the US stock exchange, ZEPP faces a unique set of challenges. Regulatory scrutiny is increasing, and the threat of delisting due to geopolitical tensions between the US and China is a real and growing concern for investors. The stock currently trades at a very low valuation, sometimes even below the company's net cash on hand. On paper, this might look like an incredible bargain, especially for value investors searching for overlooked opportunities. But there's a catch. What looks like a bargain could actually be a classic value trap. The low price reflects deep skepticism about ZEPP's ability to turn things around, and the risks may outweigh the potential rewards. The market is clearly wary. Investors are concerned not just about ZEPP's future earnings, but also about the broader risks tied to operating in China, ranging from regulatory crackdowns to unpredictable policy shifts. For those who bought in at rock-bottom prices and are comfortable with high risk, holding might make sense. But even for speculative investors, the path forward is uncertain and fraught with potential pitfalls. For new investors, the risks, especially the geopolitical ones, are simply too high to ignore. The possibility of sudden regulatory changes or a forced delisting could wipe out any potential gains overnight. Make no mistake, ZEPP Health is a real business with real products and a global presence. But as an investment, it lacks the growth story and stability that most investors are looking for right now. Margins are under constant pressure, Competition is fierce, and political factors are creating headwinds that are hard to overcome. If you're interested in the wearables sector, there are stronger, more resilient companies to consider. Ones with better margins, stronger brands, and less exposure to geopolitical risk. For most investors, the best move is to sell or simply avoid ZEPP Health altogether. Don't be fooled by the low price. Sometimes a stock is cheap for a reason. For now, the verdict is clear. Avoid. BTCS Inc. (BTCS) is a blockchain company focused on staking, earning rewards by validating transactions on proof-of-stake networks. They run validator nodes and offer staking as a service with revenue tied to crypto prices. When crypto booms, BTCS looks great. When it crashes, so does their business. Their earnings swing wildly with the market, and they've raised capital to expand, diluting shareholders. The stock is a leveraged bet on crypto, especially Ethereum and similar coins. If you're bullish on blockchain, you might be tempted. But why not just buy Bitcoin or Ethereum directly? BTCS adds company-specific risk on top of already volatile crypto exposure. You're betting on both the market and their execution. For most investors, that's unnecessary complexity. The upside is tied to crypto, but the downside is amplified. If you want crypto, buy crypto. BTCS is a sell for me. Too much risk, not enough reward. Verdict: sell. CURR is a mystery stock. Frequent name changes, vague business models, and trading on the OTC market. Companies like this often chase trends, pivoting to whatever's hot to attract attention. Financials are murky, with minimal revenue and constant dilution. Price moves are driven by hype, not fundamentals. Lack of transparency and regulation makes this a minefield for investors. It's more speculation than investment, often a story stock with little substance. The risk of total loss is extremely high. For long-term investors, there's no reason to touch this. My verdict: absolute sell. Avoid at all costs. LGPS is another micro-cap OTC stock with a history of chasing trends and business pivots. The stock is easily manipulated, often spiking on hype and crashing just as fast. Fundamentals are weak, little revenue, operating losses, and vague business plans. These are classic pump-and-dump candidates. Due diligence is nearly impossible, and the risk of losing everything is high. Investing here is gambling, not investing. Every dollar in LGPS is a dollar, not in a quality company. The odds of success are tiny. The odds of failure are huge. My verdict: hard sell. Don't get lured by the promise of quick gains. Stick to quality businesses. That's my take on these 7 trending stocks. A mix of high-risk biotech, struggling EVs, and speculative plays. Just because a stock is trending doesn't mean it's a good investment. Always do your own research, dig into the financials, and know your risk tolerance. For me, most of these are avoids. The risks far outweigh the rewards. But what do you think? Let me know in the comments. Buy, hold, or sell. If you found this helpful, hit like and subscribe for more. Thanks for watching. See you next time.